We've been talking about markets for goods with network effects, things such as social networking sites like Facebook, where people's value for participating in the site or more generally using a product or a service depends on whether they expect others to use it too. And what we saw was that the outcome in the market depends very much on what people expect to occur. If people expect a product or a social networking site to fail or to be unsuccessful, then in fact it will fail. And if they expect it to succeed, it may succeed in part just because of their expectations. That phenomena, that expectations matter and can produce multiple equilibria, happens in other kinds of markets as well, not just markets with network effects. And in particular, it happens in markets where some people have better information than others. And there are lots of markets like this. Not all markets, of course, but many are. A classic example is the market for used cars. The seller of the typical used car knows far more about the quality of that car than any buyer could possibly know about it, at least until after the buyer buys it. So we have a case where there's different information about the good that's being traded. This happens on eBay, for example, where sellers of the products they're selling know in many cases way more than the buyers know about the product, and more than the buyers could possibly know until after they buy it and actually receive it. It also happens in cases where sometimes the buyer knows more about what's being traded. Think about health insurance. Buyers of health insurance know more about how risky they are to insure than insurance companies know. Also happens in the job market. Job applicants know more about how productive they're likely to be in a job than employers know. Now, in all those cases, people make an effort to sort out this information, that is sometimes to signal how productive they're going to be or to signal how good a seller they are on eBay. But in cases where those efforts are not completely successful, we still have different information. We want to analyze how these kind of markets work. The particular topic we're going to look at is the market for used cars, which is sometimes called the market for lemons. Not lemons as in lemons, limes, and oranges, but lemons as in a particularly bad used car, or particularly bad car more generally, is sometimes called a lemon, something that is worthless. Actually, George Akerlof shared the 1991 Nobel Prize in Economics for his analysis of these markets. So we're going to build up slowly to what he actually did. And we'll start with a very simple example in which used cars can either be good or bad. The seller is going to know the quality of his car, and the buyer is not going to know. Let's suppose that buyers' values for good cars are 16 and sellers' values for good cars are 12. So if buyers and sellers could tell which cars were good, of course they would trade somewhere for a price between 12 and 16. Similarly, buyers' values for bad cars are lower, but let's suppose they're still 10, and in particular that 10 is above the value a seller of a bad used car places on his car, which we'll call 5 here. So if buyers and sellers knew which ones are bad, they too would trade at a price somewhere between 5 and 10. What's important here is that all the cars would trade if everybody could tell what they were, and they would trade at different prices. But now let's suppose that buyers can't tell which cars are good and which ones are bad. Then they can't trade at different prices. You can't have a price for a good car be different than a price for a bad car, because if that was true and the good price was above the bad price, every seller would say, hey, I've got a good car, pay me the high price. But that can't be right because bad sellers would do the same thing. So the only thing that could happen here is that all cars would sell at the same price. And we need to figure out what that price might be, or if it's even possible. Let's suppose in our little example that half the used cars out there in the population are good and half are bad, and try to figure out what might happen. Well, what's going to happen here depends on what buyers expect to happen. Suppose first that buyers expect that all the cars that are out there are going to get sold. So both good and bad cars are going to be sold. Well, that would mean that a randomly selected car has a 50% chance of being good, a 50% chance of being bad, and we can compute buyers' expected values for these randomly selected used cars. It would be half of 16 plus half of 10, which is 13. That's more than the value a seller of even a good used car puts on it, which we had to be 12. So in fact, all the used cars would trade. They would trade for a price of 13. Sellers of good used cars are getting a little bit, and sellers of bad used cars are actually getting a lot. But the main thing is that they all trade. This depended, though, very much on the assumption that buyers thought that every kind of used car was going to be actually offered for sale. Suppose alternatively that buyers are pessimistic and they think that all the used cars offered for sale are bad. They know there are sellers out there with good cars who'd like to sell them, but suppose they think that in fact all the cars that are in fact put on the market are actually bad ones. Well, then their value for any used car is 10 because all the used cars are bad if they're offered for sale. But that would be a price at which a seller with a good used car would in fact not be willing to sell his car. That's less than what he thinks it's worth. Given that expectation, then, actually all the cars that are offered for sale are bad because at a low price of 10, only sellers with bad used cars offer them for sale. So all the used cars out there are not going to be sold. Only the bad ones are sold. They're sold for a price somewhere between the maximum buyers are willing to pay and what they're worth to sellers of bad cars. That is somewhere between 5 and 10. So notice that just as with network effects, we have two different equilibria here. Which one we get depends on which one buyers expect us to get. That phenomena is something we're going to continue to study. These are called self-fulfilling expectations equilibria. The basic idea is we're looking for an equilibrium in which buyers expect something, given what they expect there's a behavior, and then we check to see if that behavior is correct. So in our case with cars, buyers expect some mix of cars to be sold, either only bad, good, and bad, or more generally, some mix of good, bad, lemons, and whatever. Given that belief, we determine what people are going to do, and we get a price. Then given that price and what people are doing, we check to see if buyers' beliefs are correct. If they're correct, we've got an equilibrium. If they're not correct, then this is not an equilibrium. Buyers are going to be disappointed, and we've got to try again. What we just noticed in the market for used cars is that we can have multiple equilibria.